Range Resources met consensus estimates this quarter, posting a Q1 2026 adjusted earnings per share of $1.52.
Right, and their GAAP revenues hit $1.03 billion, which is, it's an impressive 50% year-over-year jump.
But the real headline hidden in this report, and the thing we really need to get into today, is their massive guidance update. Range just took their full-year natural gas liquids, or NGL, price realization guidance from a completely flat baseline, and they ratcheted it up to a premium of $1.25 to $2.50 per barrel.
Over the Mont Belvieu equivalent, yeah. Which is, that is a fundamental shift in pricing power.
Exactly.
And it's a move they expect to add roughly $160 million in pure cash flow over the year.
Okay, so let's unpack this, because we are looking at a stack of earnings data and analyst notes for a company that reported zero production growth.
Yep, flat.
Completely flat year-over-year volumes.
Yeah.
Yet they posted a 50% top-line revenue explosion and suddenly found an extra $160 million in projected cash flow. That is a massive operational flat.
Oh, absolutely.
So the goal for this deep dive is to figure out exactly how Range managed to explode its revenue without actually pumping more volume out of the ground. And more importantly, how they are utilizing that cash windfall behind the scenes.
Yeah, it really is the ultimate puzzle for any exploration and production company right now. Because if your production volume is flat and Range's was completely flat compared to last year, your revenue growth has to come from somewhere else.
Right. You can't just drill your way out of it.
Exactly. You can't rely on the drill bit to bail you out. It has to come from structural advantages and pricing power, and market placement.
So let's look at that production profile to ground ourselves before we get into the actual pricing mechanics. Because in Q1, they averaged 2.21 billion cubic feet equivalent per day.
Which is a lot of gas.
It is. That comes out to 198.6 billion cubic feet equivalent total for the quarter. And slicing it up, you've got roughly 1.5 billion cubic feet per day of natural gas, 108,000 barrels per day of NGLs, and about 8,200 barrels per day of oil.
So liquids make up about 32% of their total production.
Right, which is the exact same volume profile as last year.
Yeah.
But the revenue driver here is the realized pricing. Their realized prices, and this includes the impact of their hedges, by the way, hit $4.84 per 1,000 cubic feet equivalent, or McFad.
Wow.
Yeah, that is nearly double the $2.48 per McFad they were getting in Q1 of 2025.
And to understand that massive leap, you really have to look past the wellhead. You have to look at the specific premiums they are securing in the open market, because Range isn't just taking whatever local price they can get.
Right, they're not just selling it to the guy next door.
Exactly. For natural gas, they secured a $0.18 per MCFF premium to NYMEX. That is their highest premium in over a decade.
Over a decade?
Yeah. And on the liquid side, they realized a record quarterly premium of $4.41 over the Mont Belvieu equivalent. So they were selling NGLs at $26.62 per barrel.
So as a listener looking at your own investments, this is a masterclass in why you can't just look at a company's raw production volume to gauge its health. You have to look at the plumbing.
The physical plumbing, yeah.
Right. Where exactly is their product physically going? Because historically, Appalachian Basin producers are notoriously trapped. Think of the Appalachian Basin like a massive underground reservoir of natural gas, but you only have a tiny garden hose to let the water out.
That's a great way to put it.
Right. The local market is flooded with supply. There just aren't enough pipelines to take it away, so the local price of that gas is dirt cheap.
Yeah, if you sell locally in Appalachia, you are a price taker. You absorb a massive discount just to get rid of the product. But Range has spent years, literally years, systematically building a globally diversified sales portfolio to bypass that local glut.
So they're building bigger hoses, Paris.
Essentially, yes.
Yeah.
They are sending roughly 25% of their natural gas down to the premium Gulf Coast markets, directly into the LNG liquefied natural gas export network.
Which means they aren't selling to, local utility in Pennsylvania.
Yeah.
They're effectively selling to European and Asian buyers who are willing to pay a massive premium for reliable energy.
Precisely. And they are doing the exact same thing with their liquids. They are utilizing a new East Coast export terminal that's specifically tailored for NGLs.
Oh, nice.
Yeah. So by piping and shipping their product completely out of the immediate region, they bypass those local bottlenecks entirely. They plug directly into domestic and international demand centers where, the fundamental baseline prices are simply just higher.
But wait, and this is where I'm a little skeptical. Moving physical commodities across the country, or putting them on a ship to export them globally, that is incredibly expensive.
It is not cheap, no.
So I'm looking at this massive top-line jump, but I have to wonder if the shipping costs are just eating the profit on the back end. It's like owning a bakery where you produce the exact same number of cupcakes as last year, but you found a way to truck them to a high-end boutique across town where they sell for double.
Right.
But if it costs you an extra dollar to move a cupcake that you are coming for an extra dollar, the revenue jump is just an illusion. Did inflationary pressures erode those premium prices?
That is the right question to ask. We have to evaluate the cost sheet to see the net effect. So let's look at their total cash unit costs. They crept up 3% year over year to $2.07 per mech fee.
Okay, a 3% inflation rate on costs. That doesn't sound terrible.
No, it's very manageable. Let's break down what's driving that $2.07. Direct operating expenses ticked up a penny, going to $0.14 per mech fee from $0.13.
And management specifically called out winter operations and higher water hauling costs for that, right?
Yeah, exactly. Which makes total sense, right? Fracking requires millions of gallons of water, and hauling that water requires heavy diesel trucks. So if diesel and labor go up, your water hauling costs go up.
Right.
But, I mean, a 1 cent increase on direct operations means they essentially kept their base field costs completely in check.
That's true.
The slightly bigger ticket item is the transportation, gathering, processing, and compression costs, what the industry calls GP&T. This is the literal cost of operating that garden hose you mentioned.
Got it.
That rose 5% to $1.63 per mech fee.
Okay, so what's driving that 5% jump in GP&T?
Mostly higher electricity rates and fuel prices. To move natural gas across the country, you have to push it through massive compressor stations. And those stations run on electricity or natural gas themselves.
Of course.
Right. So as energy prices rise globally, the cost to physically move and process the product naturally rises in tandem.
Okay, just rounding out the rest of the cost sheet, so we have the full picture. General and administrative G&A was $0.17 per mech fee, and DD&A, the depreciation, depletion, and amortization came in at $6.45 per mech fee.
Right.
So we do see real inflation. GP&T is creeping up. But I'm looking at the bottom line here, and the margins still expanded massively.
Well, absolutely, because the top line commodity price gains, like that $4.41 GL premium we talked about, they vastly outpaced a few pennies of cost increases per mech fee.
So the shipping cost didn't eat the profit.
Not at all. You might be paying 5% more for electricity to run your compressor stations, but you are bringing in nearly double the revenue per unit. The spread between the cost to transport the commodity and the realized price at the destination widened dramatically.
Which brings us to a part of the expense sheet that usually puts people to sleep. But here, it's actually the most fascinating number in the entire report.
I know exactly where you're going with this.
Yeah, when you comb through these expenses, their best hedge against rising operational costs wasn't a financial instrument at all. It was paying down debt. Look at the interest expense.
It is the anchor of their entire strategy. It really is.
Interest expense plummeted 36% year over year. It's down to just $0.99 per mech fee. I mean, by aggressively retiring high-interest debt, they permanently lowered their structural break-even point.
Yeah.
That 9 cents is a massive competitive advantage when you compare them to highly leveraged peers in the basin.
It shows how financial discipline on the balance sheet directly supports operational margins in the field, you know?
Yeah.
When your interest burden is that microscopic, you have a massive shock absorber.
Right. You can easily absorb those slight inflationary bumps in GP&T or water hauling costs without it ever threatening your free cash flow. Now, since you brought up financial instruments and hedging earlier, we need to address their actual derivative book. Because I'm looking at the income statement, and there's a $33.4 million derivative fair value loss in Q1.
Yes, the dreaded paper loss.
Right, and if their pricing strategy is so airtight, and they're locking in record premiums, why am I seeing a $33 million loss on derivatives? For anyone just skimming the report, that looks like a major red flag.
It does look terrible on paper, but context is everything here. As you said, this is a mark-to-market paper loss.
So let's translate that for everyone. Under mark-to-market accounting, you have to value your financial positions based on current market prices at the end of the quarter, even if you haven't actually settled those contracts yet.
Right.
But how does that generate a loss if prices are strong?
Well, Range puts hedges in place to protect against prices falling, right? It's basically an insurance policy.
Okay.
But commodity prices were actively rising during the quarter. When prices go up, the value of the insurance you bought against prices going down naturally decreases. So you have to record that decrease in value as a loss on the balance sheet, even though the underlying asset, the actual physical natural gas you are selling, is becoming much more valuable.
So it's essentially the cost of capping your upside. You agree to sell at a set price to guarantee a floor, And if the market shoots past that price, you lose the extra profit you could have made, which shows up as a derivative loss.
Yes, exactly. They capped some of their upside on the specific barrels and molecules they hedged, but the trade-off is absolute security.
Right.
Over 35% of their remaining 2026 natural gas production is safely hedged. They are locking in a floor to protect their cash flow, intentionally sacrificing some of the absolute peak pricing just to guarantee they never fall below their operational break-even.
No matter what the market does.
Right, exactly.
I also noticed a $12.8 million net loss on their natural gas basis hedges. And I have to admit, basis hedging always trips me up. If they're selling at a premium, why are they losing money on basis hedges?
Yeah, basis hedges can be confusing. Basically, a basis hedge is buying insurance on the price differential between two different geographical locations.
Okay.
So, Range wants to protect against the price gap between the local Appalachian market and the national benchmark, NYMEX. If a local pipeline suddenly goes down or there is an unexpected local supply glut, the local price could collapse while the national price stays high.
Got it.
And the basis hedge pays out if that regional gap widens too much.
But because Range is successfully moving their product out of the basin and securing that $1.18 premium to NYMEX globally,
Right.
the local Appalachian price didn't collapse relative to the national benchmark for them.
Exactly. The disaster scenario didn't happen, so the insurance policy didn't pay out. The result is a net loss on the hedge. You pay a little in basis hedging to guarantee you don't get blown up by a localized price collapse. It is risk management, plain and simple.
Which brings us to their capital expenditure program, where risk management seems to be the guiding philosophy as well. We've established they are generating a mountain of cash, they're hedging aggressively, and they are keeping production totally flat.
Yep.
So let's look at what they actually spent to put pipe in the ground. In Q1, they spent $130 million on drilling and completions. They drilled 143,000 lateral feet across just 9 wells and turned 17 wells to sales.
And that lateral footage metric tells a major story.
Right, 143,000 feet across just 9 wells. That means they're drilling nearly 3 miles of horizontal pipe per well.
Yeah, they aren't poking dozens of small holes in the ground anymore. They are relying on massive, highly efficient mega wells to maintain that flat production profile with minimal surface impact.
And total capital spending for the quarter was $139 million. Now, against an annual budget of $650 to $700 million, that means they've only burned through 21% of their capital budget in the first 3 months of the year.
It's incredible restraint. CEO Dennis Degner and his team, they're executing a highly disciplined multi-year plan, and they refuse to deviate from it. I mean, Range has over 30 years of high-quality Marcellus inventory.
30 years?
Yeah, they have the reserves in the ground, but they're keeping their reinvestment rate incredibly low, under 50% of $3.75 gas.
Okay, here is where I have to push back on management's strategy just a bit, because Wall Street usually punishes exploration and production companies that don't show aggressive growth.
Sure.
If you have 30 years of high-quality inventory and you are realizing near-record premium pricing across the board,
Yeah.
why aren't investors screaming at them to put more rigs to work? Why take more than half your cash flow and just sit on it instead of chasing the drill bit while prices are high?
It's a fair question, but it comes down to the macro risks. Management explicitly flagged several geopolitical factors in this report that are keeping them cautious.
Like what?
Well, they are looking at the actions of OPEC, the ongoing Russia-Ukraine war, military action in the Middle East, flows of energy through the Strait of Hormuz, and, the shifting dynamics of global LNG demand.
Let's unpack the Strait of Hormuz for a second, because that is a massive geopolitical choke point.
Yeah.
How does a Middle Eastern shipping lane dictate the drilling strategy for a natural gas company operating in Pennsylvania?
Good question. Roughly 20% of the world's global LNG supply passes through the Strait of Hormuz. If there is a military disruption there, global LNG supplies tighten dramatically.
And prices jump.
Exactly. International prices would skyrocket, pulling U.S. natural gas prices up as European and Asian buyers scramble for American exports to fill the void.
But on the flip side, if the conflict cools down, or say OPEC floods the market, or there's an unexpectedly mild winter in Europe, global demand could soften just as quickly.
Yep.
The premium pricing could vanish overnight.
Which is exactly why Range is sitting on its hands. I mean, think about it. If they ramp up capital spending today to drill more wells, it takes months to bring that production online. By the time the gas actually flows, the macro environment could have flipped.
So you risk overproducing into a saturated market and crashing your own margins.
Precisely. Their strategy is to maintain a flat, predictable volume, ride the international pricing premiums for as long as they last, and harvest the cash regardless of geopolitical swings.
So if you are a retail investor listening to this,
Yeah.
here's the million-dollar question. If they aren't dumping this massive cash windfall into drilling new wells, we need to look at how they are structurally changing the company's financial DNA.
Right.
Where's all this money going?
The balance sheet. That's where this operational restraint truly translates into corporate value.
Okay.
In this single quarter alone, Range generated $619 million in operating cash flow. And they took that cash and went straight to work fortifying the balance sheet. In January, they fully redeemed $600 million of their 8.25% senior notes that were due in 2029.
Okay. I noticed a very specific detail on that redemption, though.
Yeah.
To retire that debt early, they took a $12.3 million loss on early extinguishment.
Yeah, they did.
And that included an $8.2 million premium just to get the debt off the books. They actually paid an $8.2 million penalty just for the privilege of paying off their own debt early. That sounds like terrible capital allocation on the surface, doesn't it? Why pay a penalty when you could just let the debt ride?
It sounds counterintuitive, I'll give you that. But do the math conceptually. You are carrying $600 million in debt at a punishing 8.25% interest rate. That is roughly $50 million a year just in interest payments, bleeding out of your cash flow every single year until 2029.
Oh, wow. Yeah, when you put it like that.
Right. So by taking a one-time $12 million hit today, you wipe out hundreds of millions of dollars in future interest obligations. It's a short-term paper penalty for a massive long-term structural advantage.
Which perfectly explains why their ongoing interest expense plummeted to just 9 cents per McKay. We are seeing the immediate result of that early payoff.
Exactly. And the result on the broader balance sheet is staggering.
Yeah.
Because of that move, their net debt is now down to just $834 million.
Wow.
Yeah, that puts their leverage at a microscopic 0.5 times debt to EBITDAX.
So for those who don't spend all day looking at oil and gas balance sheets, EBITDAX is earnings before interest, taxes, depreciation, amortization, and exploration expense. The X is crucial here.
Very much so.
Because I used to just look at standard EBITDA, but for an E&P company, exploration costs can be massive and highly variable. So stripping the X out gives you a much clearer picture of the baseline cash the actual producing wells are generating.
Right.
And a leverage ratio of 0.5 times means they could theoretically pay off every dime of their corporate debt with just 6 months of earnings.
Which, for an industry that is historically famous for boom and bust cycles driven by too much leverage, that is fortress-level balance sheet strength. I mean, it completely insulates them from commodity price crashes.
So the debt holders are out of the picture. What about the equity holders? How are the shareholders being rewarded for this discipline?
They are seeing the returns directly. Range repurchased 800,000 shares during the quarter for $27.1 million, which is an average price of $33.91 highs per share.
Nice.
And on top of that, they paid a $23.8 million dividend, which comes out to $0.10 per share. That represents an 11% increase in the dividend year over year.
And it is worth noting they still have $1.5 billion left on their share repurchase authorization. So they have massive amounts of dry powder to just keep buying back their own stock if they feel the market is undervaluing them, especially with that sub 50% reinvestment rate.
Yep.
They're generating the free cash flow to comfortably fund the dividend, buy back the stock, and hold debt at near zero levels all at the same time.
When you operate from a position of absolute financial strength, you generate the ultimate luxury in this industry, which is flexibility. They don't have to drill. They choose to drill only when the margins make sense.
Which leaves us with a fascinating forward-looking puzzle to ponder as you look at your own portfolio. We've established that Range Resources generated nearly $620 million in operating cash flow in a single quarter while keeping their production totally flat.
Right.
But look ahead to 2027. Next year, they have massive incremental capacity coming online. We are talking 300 million cubic feet per day of new processing capacity.
And another 250 million cubic feet per day of new Midwest and Gulf Coast takeaway capacity.
Exactly. They have essentially spent the last few years building a private toll road out of Appalachia straight to international pricing, and investors are just now starting to see the very first tolls collected.
It's a massive setup.
It really is. So what happens to their free cash flow yield when the traffic on that road suddenly doubles, and they still have no expensive debt eating into the profits? It is something to keep a very close eye on. Make sure you follow the show for our daily earnings coverage as we continue to break down the most important numbers across the market.